Well, I think this notion of China cleanse. It's something that sort of came to me when I looked across our portfolio, and I in preparation this morning even for a conversation that I had with a group at Bloomberg about tobacco. Raised the same point. I was going over some numbers, and against a group of 5 tobacco companies: Philip Morris, British American Tobacco, Altria, Reynolds, and Lorillard. The 3 domestic-only companies had share prices that total returns for the past 12 months were sort of mid-teens plus higher for Altria, maybe even 30%. Over the same 12-month period, Philip Morris and BAT, I think Philip Morris may have been down 10%, BAT down 5%. Well, that is a direct market vote against emerging markets and in favor of sort of the North American, easy to own, no apology needed marketplace. Because once you end up with something like what's happened in the last 18 months, really almost post the first taper, and you've seen that massive reset of expectations that have gone negative on the developing emerging markets, then investors basically go through their portfolio and try to cleanse it of the risks of looking like they have exposures, which to anyone thinking at this very minute seem imminent. They try to get rid of those risks. Now, I actually think in the process of doing that extensively, you actually are getting rid of return, because it will be from those markets that returns will come to companies that have strong brands, which are aspirational in those markets, maybe not yet fully available, but certainly aware and aspirational to the consumer. And it'll come because the consumer there'll be more of them, because they happen to be the parts of the world that have population growth, unlike the somewhat anemic West. They'll have more people, and those more people will be able to afford more because those consumer disposable income numbers will rise in those markets. So you probably want to be involved with businesses that are positioned well enough to take advantage of that. If you look at the partnership that I oversee, Sempervic Partners, and look back over the vast suite of its existence starting in 1983 or 1984, I would allege that a big part of the returns that it's generated have come from the fact that we've been fortunate enough to harness the power of strong branded goods companies that have management dedicated to investing upfront to develop their product in advance of the advance of emerging markets, so that when the consumer is available and can afford, they have something to buy. And that first mover advantage has very important ramifications later on because of the brand preference. And so I would say, if you look back at as early as 1984, 5, and 6, the portfolio holdings in companies like Nestle, Heineken, Philip Morris were already beginning to be benefited by a tailwind that only accelerated once 1989 came along. The markets opened up in countries like formerly closed countries like the Eastern European and Russian market. China opened up. India began to open up. Brazil started to have an economy that looked outward. Vietnam more recently has become a soaring market for many of our companies. And that tailwind has been extremely helpful.